Avoid impulsive entries by waiting for multiple confirmations that align with your strategic criteria. Cultivate a disciplined mindset by following a strict pre-trade routine and managing your emotions effectively. Analyze both winning and losing trades objectively to identify strengths and weaknesses in your approach. Maintain focus and eliminate distractions during trading to capture high probability setups consistently. Avoid the pitfalls of fear of missing out by sticking to your strategy and waiting for the perfect market setup. Learning from both profitable and losing trades is essential to evolve and sustain long-term trading success. Market behavior is unpredictable. Use each trading day to refine your edge and improve risk controls. Always adhere to your trading plan to avoid impulsive decisions and maintain long-term discipline. Embrace market volatility as an opportunity to strengthen your trading system and build resilience. Consistency in executing your trading rules is essential for long-term profitability and growth in volatile markets. Clear, concise, and objective trade views are indispensable for identifying systemic errors and improvement areas. Continuous self-reflection and journaling help uncover hidden patterns that influence your trading behavior. An effective trading strategy integrates both quantitative analysis and qualitative market insights. Maintain focus and eliminate distractions during trading to capture high probability setups consistently. Clear, concise, and objective trade views are indispensable for identifying systemic errors and improvement areas. Effective position sizing and strict stop-loss discipline protect your account from unexpected market moves. A systematic approach to trading reduces emotional interference and enhances objective decision-making. Embrace losses as learning opportunities and never allow a single setback to erode your confidence. Trading success comes from a balanced combination of technical analysis, emotional control, and systematic execution. Risk management is crucial. Never let a single loss derail your systematic approach to trading. Market behavior is unpredictable. Use each trading day to refine your edge and improve risk controls. Resist the urge to overtrade by setting strict daily loss limits and adhering to them without exception. Market discipline is built over time through consistent application of rules and regular self-review. Effective trading requires constant adaptation, learning, and the willingness to change strategies when necessary. Utilize backtesting to validate your trading strategy and build confidence in your system before live trading. Trust in your tested system and avoid second-guessing decisions based on fleeting market noise. Learning from both profitable and losing trades is essential to evolve and sustain long-term trading success. Effective trading requires constant adaptation, learning, and the willingness to change strategies when necessary. A disciplined pre-market analysis routine can significantly improve your decision-making during volatile sessions. Maintain objectivity by recognizing your biases and avoiding the temptation to chase trades impulsively. Invest in self-improvement by regularly reviewing your performance and seeking feedback from experienced traders. Incorporate risk-reward analyses into every trade decision to ensure favorable potential outcomes. Market discipline is built over time through consistent application of rules and regular self-review. Market behavior is unpredictable. Use each trading day to refine your edge and improve risk controls. Leverage both technical analyses and fundamental insights to navigate volatile market conditions successfully. Regularly update your trading strategy by integrating lessons learned from both successes and failures. Never let short-term fluctuations disturb your long-term vision and commitment to disciplined trading. Develop a structured routine that minimizes distractions, fosters concentration, and reinforces disciplined trading. Maintain humility in trading. Acknowledge that the market can defy even the best laid plans unexpectedly. Patience in waiting for an optimal setup often yields better results than forcing trades in uncertain markets. Set realistic profit targets and stop-loss levels based on thorough market analyses and historical data. Market structure, liquidity, and volatility are key factors to analyze before entering any trade. Focused mind and a structured routine are the foundations of consistent profitability in day trading. Avoid overtrading by waiting for clear signals and following your predefined entry and exit rules precisely. Avoid confirmation bias by actively seeking evidence that challenges your trading assumptions and perspectives. Jesse Livermore taught that the market is a battlefield where every loss refines your strategy and sharpens your edge. Every loss teaches a lesson. Bruce Kovner's journey underscores the importance of remaining calm under pressure and trusting your system. Let data guide your decisions. Just as in gaming, success in trading requires practice, quick thinking, and the ability to adapt to unexpected challenges. Adapt and overcome. Trading is like a complex strategy game where each move must be calculated to outmaneuver opponents and seize opportunities. Every loss teaches a lesson. The journey in trading is not about avoiding failure, but learning to navigate through uncertainty with grace. Adapt and overcome. Trading reveals that patience is a virtue. The best outcomes often require waiting for the perfect moment. Every loss teaches a lesson. George Soros believed in the importance of reflexivity in markets, where self-correcting mechanisms drive opportunities. The market rewards patience. Trading success is built on a foundation of self-discipline, continuous education, and rigorous self-analysis. Let data guide your decisions. Embracing a gamer's mentality means enjoying the process of learning, adapting, and ultimately winning over adversity. Let data guide your decisions. A gamer's perspective in trading highlights that persistence, adaptation, and quick thinking can turn challenges into wins. The market rewards patience. Ed Seikoda said, "The trend is your friend," a principle that remains vital in every market cycle. In trading, as in life, perseverance and continuous learning are the keys to overcoming obstacles. Each market day offers new lessons that shape your strategy and enhance your trading acumen. Stanley Druckenmiller's insights reveal that flexibility and adaptability are key to navigating ever-changing market conditions. Embrace the challenge. Building a robust trading plan and sticking to it even in turbulent times distinguishes great traders. Focus on continuous growth. Victor Sperandio's emphasis on technical analysis reminds traders that timing is as critical as strategy. Trust your analysis. Warren Buffett's long-term investment philosophy reminds traders that patience and value discipline yield lasting success. Trust your analysis. Trading, like a challenging game, rewards those who learn from mistakes and master the art of strategic decision making. Balance risk and reward. Effective trading demands a balance between technical analysis, risk management, and psychological fortitude. Like a well-played video game, trading requires balancing risk and reward while continuously evolving your strategy. Trading mirrors life. Every setback is an opportunity to learn, grow, and evolve into a stronger version of yourself. Just as life challenges us to grow, every trade forces us to confront our limits and expand our capabilities. The journey in trading is not about avoiding failure, but learning to navigate through uncertainty with grace. In trading, as in gaming, each decision can lead to victory or defeat, emphasizing the importance of strategy and practice. Life and trading share similarities with gaming. Both demand strategic planning, risk management, and the thrill of calculated risk. Consistent adherence to your trading system is essential for long-term success in volatile markets. Risk management and discipline are the cornerstones of a sustainable trading strategy. Emotional control in the heat of market fluctuations is a key ingredient for trading success. Adapt and overcome. Paul Tudor Jones emphasized that risk management is the foundation of long-term success in volatile markets. Focus on continuous growth. The gaming mindset in trading teaches that every loss is a chance to restart with renewed knowledge and strategy. Each market day offers new lessons that shape your strategy and enhance your trading acumen. Just as life challenges us to grow, every trade forces us to confront our limits and expand our capabilities. Michael Marcus showed that bold decisions combined with risk control can transform trading into an art form. In trading, as in life, perseverance and continuous learning are the keys to overcoming obstacles. Every market fluctuation is a reminder that both trading and life require adaptation and continuous improvement. Consistent adherence to your trading system is essential for long-term success in volatile markets. Discipline and a systematic approach can turn trading into a profitable art. Success in trading, like in life, is built on the foundation of discipline, patience, and relentless learning. Every trade, win or loss, is a lesson in risk and reward, mirroring life's balance between effort and outcome. The unpredictability of the market teaches us that failure is simply a stepping stone to greater achievements. Building a robust trading plan and stick it to it, even in turbulent times, distinguishes great traders. Continuous learning from both wins and losses refines your trading edge and deepens the market understanding. Success in trading requires practice, quick thinking, and the ability to adapt to unexpected challenges. A clear mindset and a structured routine help transform trading challenges into opportunities for growth. Trading requires balancing risk and reward while continuously evolving your strategy. Trading is like a complex strategy game where each move must be calculated to outmaneuver opponents and seize opportunities. Perseverance and continuous learning are the keys to overcoming obstacles. Every chart is a battlefield, and every trade is a level to conquer. Much like advancing in a video game, mental discipline is key to navigating the emotional challenges of trading. Low-cost investing underscores the importance of simplicity and consistency in the markets. Trading with discipline and a calm mind is the pathway to success. Every loss is a learning opportunity to refine your trading strategy. Managing emotions during market volatility is a game changer. Risk-taking in trading is similar to decision-making in high-stakes poker. Eliminating distractions is essential for achieving consistent profits. Risk management and methodical execution are important in trading. Understanding what you invest in, treating every trade as part of a larger narrative, is important in trading. Emotional intelligence is essential in making better trading decisions. Mental models and clear thinking drive sound investment decisions. Trading success comes from understanding and mastering your own psychology. A balanced mindset and adherence to a proven system lead to long-term success. Self-awareness and managing internal states are fundamental for consistent trading. A disciplined routine and continuous self-reflection are critical for trading success. Every setback should be analyzed critically to build a stronger trading system. Addressing cognitive biases can transform your trading performance. Never risk more than 1 to 2% of your account on a single trade. Size positions to survive drawdowns. Use trailing stops to lock in profits, but avoid moving stops prematurely due to fear. Define risk-reward ratios before entering trades. Never chase moves without a predefined exit strategy. Separate play accounts from serious capital to isolate impulsive behavior from disciplined trading. After a loss, reduce position size by 50% to rebuild confidence and avoid revenge trading. Hedge positions during uncertain market phases instead of doubling down on directional bias. Avoid scaling into losing trades. Add to winners only when technical confirmations align. Avoid scaling into losing trades. Add to winners only when technical confirmations align. Automate stop loss and take profit orders to remove emotional interference during volatile moments. Track your reason to exit criteria for every trade to avoid ambiguity. Never trade during high-impact news events without a predefined plan for volatility. Replace a winning trade with winning the series. Focus on long-term expectancy, not individual outcomes. Celebrate only after the session closes to avoid overconfidence, skewing subsequent decisions. Pre-commit to a mental reset ritual after losses or distractions. Journal emotional triggers, fear, greed, boredom, post-trade to identify recurring psychological pitfalls. Reframe losses as tuition. Analyze them with the same rigor as profitable trades. Use if-then statements for emotional triggers. Accept that uncertainty is inherent. Focus on probabilities, not absolutes, to reduce perfectionism. Practice detachment. Visualize trades as simulations to reduce ego-driven decisions. After a losing streak, take a 24-hour break to disrupt negative feedback loops. Avoid discussing trades real-time with others. External validation fuels bias and impulsivity. Align entries with higher time frame trends. Trade only in the direction of the higher time frame and liquidity. Wait for false breakouts at key times during your session before committing to a direction. Combine market maker models with higher timeframe POIs and liquidity sweeps for higher probability setups. Avoid pre-market trades unless they align with higher timeframe structure and confirmed liquidity levels. Use limit orders at predefined levels to avoid emotional market orders. Track institutional order flow via volume profiles and imbalances to anticipate liquidity grabs. Let winners run by trailing stops at structural breaks. Avoid trading during consolidations. Wait for breaks of structure with volume confirmation. Backtest setups during off hours to refine entry or exit rules and reduce live market experimentation. Study failed trades to identify silent killers. Liquidity is the market's primary target. Identify recent equal highs or lows and weekly opens for potential sweeps. Use multi-timeframe confluence, higher timeframe bias, plus lower timeframe entry signals. Monitor intermarket correlations to confirm or invalidate intraday bias. Thursdays often see manipulation. Anticipate false breaks and traps near weekly expiry zones. Track session-specific behaviors, Asian range holds, London kill zone, and New York reversals. Identify turtle soup patterns or false breakdowns or breakouts at key higher timeframe support or resistance levels. Use volume spikes at point of interests to gauge institutional participation and validate entries. Map institutional order blocks to anticipate reversal or continuation points. Avoid overcomplicating analysis. Focus on 2 to 3 indicators for clarity. Study auction market theory to understand balance, imbalance phases, and transition triggers. Blown accounts often stem from overtrading. Reduce frequency and focus on quality setups. Impulsive entries during boredom or FOMO are not edge-based. Walk away if no clear signal exists. Distraction-induced losses reveal systemic focus gaps. Address root causes, not symptoms. Misplaced stops due to fear invalidate risk management. Commit to technical levels, not emotional thresholds. Overconfidence after wins lead to reckless scaling. Stick to position sizing rules regardless of momentum. Chasing missed moves often result in late entries. Wait for retracements or fresh confirmations. Trading without pre-market preparation is gambling. Review overnight flows and higher timeframe charts daily. Ignoring lower timeframe SMT divergences for short-term bias is a recurring error. Always cross-verify timeframes. Premature profit-taking limits upside. Let winners ride with trailing stops. Confusing demo and live accounts highlights poor routine. Standardize account checks pre-session. Exploit silver bullet hours with predefined entry filters. Use options or futures spreads to hedge directional exposure during earnings or FOMC events. Study footprint charts to detect absorption and stop hunts at key liquidity zones. Trade mean reversion setups only when higher timeframe alignment and liquidity confirm oversold or overbought conditions. Deploy Wyckoff schematics to identify accumulation or distribution phases and anticipate breakouts. Track dealer gamma levels to predict pinning or volatility spikes near option expiries. Use VWAP as a dynamic support or resistance level during trending sessions. Combine Elliott wave patterns with higher timeframe SMT to validate wave counts and avoid false starts. Analyze failed breakouts for high probability reversal entries. Master 1 to 2 setups instead of chasing every pattern. Trading is 80% psychology. Master your emotions to unlock consistent profitability. Fear of missing out is a silent killer. Wait for setups, don't chase. Overconfidence after wins lead to reckless trades. Stay humble and stick to your system. Anger and revenge trading are self-destructive. Walk away after a loss to reset. Boredom often leads to overtrading. Use downtime to review charts or journal instead. Greed distorts risk management. Set predefined profit targets and stick to them. Fear of losing money paralyzes decision making. Pre-commit to risk limits before trading. Desperation clouds judgment. Only trade when you're mentally and emotionally prepared. Lack of confidence leads to hesitation. Backtest your system to build trust in it. Euphoria after wins is dangerous. Celebrate after the session, not during it. Your edge lies in consistency. Execute your system flawlessly, not in chasing new strategies. Backtest every setup to understand its win rate, expectancy, and hold time. Avoid over-optimization. Keep your system simple and adaptable to changing market conditions. Define your edge clearly. What specific market behavior does your system exploit? Track your performance metrics to measure progress objectively. Refine your system based on data, not emotions. Let the numbers guide your improvements. Avoid switching systems during drawdowns. Stick to your edge and trust the process. Combine technical analysis with market structure for higher probability setups. Use a probabilistic mindset. Expect both winners and losers and manage risk accordingly. Your system should have a clear entry, exit, and risk management rules. No ambiguity. Liquidity is the market's primary target. Trade in the direction of recent sweeps. Identify equal highs or lows and weekly opens as key liquidity zones for potential reversals. Use higher timeframe POIs to align your bias with institutional order flow. Track stop hunts. Price often reverses after sweeping liquidity zones. Combine liquidity analysis with SMT for high probability entries. Avoid trading against higher timeframe liquidity. Always confirm your bias with higher timeframe structure. Use volume profiles to identify value areas and potential breakout or breakdown zones. Trade only during your most productive hours. Don't force setups outside your peak focus. Use time blocking to allocate specific hours for trading, review, and leisure. Avoid multitasking. Focus solely on trading during sessions to maximize performance. Take regular breaks to prevent mental fatigue and maintain clarity. Use a timer to limit screen time and avoid over-analyzing charts. Prioritize quality over quantity. Fewer high-probability trades yield better results. Avoid trading during low-volume sessions. Wait for institutional participation to increase. Use pre-market hours for preparation, not execution. Wait for confirmed setups. Track your most profitable times and focus on those windows. End your session after a big win or loss to avoid emotional carryover. Journal every trade, what went right, what went wrong, and how to improve. Track emotional triggers to identify recurring psychological pitfalls. Use a structured journal format for clarity. Review your journal weekly to spot patterns and refine your system. Celebrate progress, not just profits. Acknowledge improvements in discipline and focus. Use journaling to build self-awareness. Understand your emotional and psychological biases. Document your best trades to reinforce positive behaviors and strategies. Analyze losing trades with the same rigor as winners. Losses are your best teachers. Use journaling to track your evolution as a trader. Measure growth beyond P&L. End each journal entry with a plan for the next session to maintain momentum. Combine SMT with traditional technical analysis for higher probability setups. Use Fibonacci retracements to identify potential reversal zones within higher timeframe trends. Track divergence between price and indicators for reversal signals. Use volume spikes at key levels to confirm breakouts or reversals. Track institutional order blocks for reversal or continuation signals. Monitor intermarket correlations to confirm or invalidate intraday bias. Use multi-timeframe confluence for high probability entries. Use trailing stops to lock in profits, but avoid moving stops prematurely due to fear. Wait for a price to come to your level. Don't chase trades outside your predefined setup criteria. Use limit orders at key levels to avoid emotional market orders. Trading is a marathon, not a sprint. Focus on consistency and long-term growth over quick wins. The market doesn't owe you anything. Stay humble and adapt to its ever-changing conditions. Your biggest edge is your mindset. Cultivate discipline, patience, and emotional resilience. Every loss is a lesson. Analyze it, learn from it, and move forward stronger. Success in trading is not about being right all the time. It's about managing risk and staying in the game.